Welcome back to the Manor. Julian McBain here, and we are back with Personal Finance for Gamers. Okay. Get ourselves hunting some Panleon. And we actually had a global in the last video. That surprised me. Always good to have those globals. So today we're going to be going into the next subject of personal finance, and that's credit. It may seem like credit should not necessarily be the second major thing we talk about, but the reason that we're going to talk about the second is because after the budget, credit is the thing that really can affect you the most. And you might be going, well, what about investments? What about savings plans? What about da-da-da-da-da? Credit is where most people get the hang up. Using credit properly versus using credit improperly. This is a very deep subject, and we're going to be getting into as much depth as possible. So expect credit to be the topic for several weeks. Today is going to be a simple introduction. We're going to do a lot of surface level about the subject, and then in coming videos, we're going to talk about individual pieces of credit so you can break down and really become experts on how credit works. But before we get started, if you're new to the channel, welcome to the Manor. Please take a moment and subscribe down below. We are on the road to 13 million subscribers, one subscription at a time, so make sure you subscribe. Also, please consider going to patreon.com/JulianMcBain if you want to support my work. If you do, you'll get exclusive content. I put out at least one exclusive video every month, and I've been working on adding content, some of it random, some of it meaningful, on the Patreon. So if you want to become a member, you'll get all that exclusive content. You'll also get a copy of Personal Finance for Gamers for download, which is what this content is based off of, as me writing that book. So you have that. Okay. Intro to credit. When most people think about credit, they tend to think about credit cards, which is fair because it's right in the name, right? Oh, just use credit. It's much more complicated than that. Credit is a set of tools that you can use to more efficiently plan your finances. Here's the problem. It's also really easy to screw up and get sunk. Okay? Credit works on debt. Debt, of course, is money you borrow. And I'm going to get that specific sometimes in case I've got younger people, like your teenagers, watching these videos. I think it's very important for them to know this information before it really affects them, because it will affect them. If you don't think it's going to affect you, you got another thing coming. So, credit is more than debt, but it's mostly debt. The information regarding how you handle your debt gets reported to one of three bureaus: TransUnion, Equifax, or Experian. And they have something called your credit report. That credit report is then used by all kinds of people to see what your integrity is like. How responsible are you? It's really a tool that they can use to figure out pieces of your personality. And actually, scientifically speaking, they can actually track the probability of you having a car accident by your credit. Dead serious. Because the more responsible you are with credit, the more responsible a driver you are, statistically speaking. So, credit means a lot. Debt also means a lot. And the more debt you get into, the easier it is to go into debt. Why? The Pareto principle. We talked about this the last time. The more you get, the faster it accumulates. This is compounded, no pun intended, by interest. Interest being that thing that constantly you pay for borrowing money. That's the price of money. Now, as it happens right now, we happen to be in a time period where money's the cheapest it's ever been. Because it's been so cheap for so long, we're hitting a major inflationary cycle. So, if you have debt now is the time to get rid of your high interest stuff for low interest stuff. This is not an ad to go talk to any specific bank. It is worth talking to your banker about. Debt can be used in one of two ways. It can be a liability, or it can be leverage. When you hear about a company being leveraged, they're talking about debt. When is debt a liability versus when is it leverage? Debt is a liability when you're putting everything on credit cards and not paying it off at the end of the month. It's a liability when you allow the amount that you pay on your debt to be more than a certain percentage of your income. This is called debt to income ratio, and that number is 40%. 40 is a really important number to debt, as it turns out, or to credit, as it turns out, which is ironic because it's a pretty biblical number. Funny how that works. So we will get into all of that in other videos, but the fact of the matter is when you use it correctly, for instance, what are good things, examples of things that are good, that debt can be used effectively and used as leverage as opposed to liability? A mortgage on a house, that's leverage. You're utilizing debt, there's an underlying asset. Debt to buy equipment for a business. There's a debt, there's an underlying asset, the equipment you bought, which can then be turned around and sold to pay off the debt if necessary. Your car, underlying asset. Most of your secured debt is more leverage than liability. Now, there are times when that can be a liability. We saw that in 2008. Housing market bubble popped. People had way more debt than their houses were worth. Well, that turned that leverage into a liability really quickly. So when you're taking those secured debts, you have to be very careful. There's one other way that you can use credit as a leverage, and this is using a credit card, believe it or not. And when we get into credit cards, we're really going to get into the strategy of this, but credit cards in particular often have points programs. If you pay all your expenses on your credit card and then pay the credit card completely off, say that again, pay the credit card completely off every single month, that's leverage. Because what you did is you earn points, which you can then get used to go places or to buy stuff, right? So you're actually earning using your card rather than spending or losing. And you're not letting the high interest rate affect you because the interest rate doesn't kick in until the month after the first due date on any purchase. And again, we're going to get into the mechanics of credit cards. That'll have its whole own video, but that's how you can use a credit card as a leverage. So, okay. Liability when poorly managed, leverage when well managed. That's the synopsis of that piece. And it's important not to neglect, because good credit affects getting an apartment, affects getting a job, affects all kinds of different things. So you have to be able to utilize debt effectively and not let yourself sink. Okay. I say there are two types of debt. There's two segmented categories that each have two types of debt. So we're going to call two types of debt and two modes of debt. The two types of debt are secured and unsecured. The two modes of debt are installment and revolving. Okay, let's break that down. What is secured debt? Secured debt, we previously called it a type of leverage, is any debt that has any form of underlying asset securing the debt. You stop paying the debt, the bank comes and takes the asset. It's that simple. Mortgages, auto loans, certain business equipment loans. All secured debt. Buying tractors if you're a farmer, secured debt. All of that is secured. You fail to pay it back, bank comes and takes the asset, and your credit gets hurt. Unsecured, the only thing it's on is your good name. What's the benefit to this? You fail to pay it back, whatever you bought with it doesn't go away. What's the downside to this? The hit to your credit's even heavier than it might have been with secured debt. And more importantly, you're still responsible to pay it back, and your interest rates are going to be higher. So yeah, those are the things you need to worry about there. And we'll get into interest in just a minute here. The two modes of debt are installment and revolving. Installment credit is a mode of credit where you take out a chunk of money like a personal loan. You have a monthly payment. You can't take out any additional debt on that loan. You just pay it off. You retire it over time, pay it off over time, and when you're paid off, it's done. It's gone. No more debt. Or at least not that particular debt. That debt's gone. You can't just take out more. You have to get a whole new loan to take out more. Revolving is the opposite. These are your credit cards and lines of credit. As you pay off the debt, that credit becomes more available for you to use again. The benefit to revolving credit over installment credit is that it is available for you to use when you need it. And as you pay it off, you don't have to do a whole new application in order to access it again if something happens. However, the downside is inevitably installment credit has lower interest rates. The cost of borrowing those dollars is cheaper because there's a fixed term and you can't get yourself sunk in it any more than the original contract. Now, if you lose your job or something like that, obviously that becomes a problem, but so long as nothing else changes, the bank knows that as long as all the information you gave them is accurate, you can make that payment every month. They're going to give you that lower interest rate because they know they're going to get their money back over time. You pay that lower finance charge, which is the amount of interest you pay over the life of the loan. Again, we're going to have a whole video on interest and finance charges, but we're going to gloss over that here in just a minute. But the revolving isn't always like that. Okay. Failing to repay your debt will disrupt your life. Period. Dot. Why will it disrupt your life? Because when you fail to repay your debt, it goes on your credit report. All that information comes down. Your landlord's going to pull your credit report when you apply for an apartment. Your job, a lot of jobs pull credit reports too. And they do this to see what your integrity is like, whether you're going to be responsible. People that are really deep in debt, have poorly managed debt or credit, are more likely to steal in order to because they're desperate. Not necessarily because they are intrinsically bad people, but they're far more likely to be desperate. They might do something that they normally wouldn't. They might steal from the vault. They might try to, grab merchandise for free so they don't have to pay for their lunches. These are all things that credit reports and credit have shown people's behavior to work. How they've shown people's behavior to work. So it's very important that you manage your debt well. Now, that doesn't mean you're not going to make mistakes. Okay? There's a reason that things only stay on your credit for 7 to 10 years. Because every decade of your life, you change significantly. 20-year-old you is much different from 30-year-old you, is much different from 40-year-old you. And so mistakes made at 20, you can redeem yourself by fixing things and being okay at 30. And those bad debts drop off your credit. That doesn't mean you want to let it happen again. And that doesn't mean you just screw around when you're in your 20s. Because believe me, not a good thing to have to deal with for the next 10 to 15 years. Okay. Whenever you take something out on credit, you're going to pay a price for taking it out. There's a number of terms for this. Some are more legal, some are more colloquial. Most people think of it as interest. And the joke back in the 90s was, well, I'm not interested. Well, yeah, you are because you took out the debt. What the actual term for this is finance charge. Finance charge is the total amount of money you will pay over the life of the borrow, of the loan, or however long it takes for you to pay back that credit card debt. The faster you pay back the debt, the less finance charge you will pay, which is why it's always good to pay more than your minimums, whether it's an installment loan or a credit card. Credit cards, it's even more important than installment loans because credit cards are basically set up to be 30-year loans. If you actually look at the payment mode and how you pay it off, you can calculate it out. It takes anywhere between 25 and 30 years to pay off your average credit card at minimum payments. And it's designed like that. So you don't want to use it for long-term borrowing. Interest rates are expressed as an annual percentage rate. Sorry, I know that's backwards. Annual percentage rate. The annual percentage rate is the total amount of the principal that will be re-added to the loan over the course of a year. So for instance, if you have a 14.99% interest rate or annual percentage rate, that loan, assuming no payments are made, will grow 14.99% over the next year. Now, of course, you're going to be making payments on it. It's not that simple. So they actually break it down to what they call a per diem. Interest accumulates on a daily basis, and it compounds generally monthly. So if you go to make a payment, if you fail to make a payment, then that month's interest gets put into the principal of the loan, and you start paying interest on that interest. Not a good place to be. This is especially the place you feel this the most is on student loans, because you end up spending 4 years not paying on them because the interest is not necessarily waived, although there are some loans that do that. It's just deferred. You're still accumulating that interest, but it's deferred, so you don't have to pay it right now. College students, if you can handle a job with your college time, get the job, pay the loans while you're in college. You'll pay far less overall than your peers will. Just holding down a job and putting an extra $100 or $200 a month on a college loan that you took out, even though the loan's not going to be paid off when you get out of school, you'll pay thousands less in interest if you do that. Thousands. Over the course of the life of those loans. Because those are 10-year loans. Those are easily 10-year loans after you start paying on them. And some of them are longer. So just be aware of that. Interest compounds quick. It's how you earn money on investments. It's how the banks earn money on the debt you take out of them. Because for the bank, that interest pays for their lights, it pays for their buildings, it pays for their salaries and staff. It also pays back their depositors, which is where that money comes from. So we're going to get into that too. So that is your basic introduction to credit. A couple of takeaways from this that you need to have. 1, debt is not in itself intrinsically bad. Okay? Debt is a tool. Debt's a tool just like a knife or a firearm is a tool. It's a dangerous tool if you're not responsible with it, and it can ruin your life if you're not responsible with it. But it's a tool. It's not intrinsically good or bad. Well-managed debt will help you manage your budget and your future far more efficiently. Poorly managed debt will screw your life up so fast your head will spin. Because one day you're going to look at your wallet and realize that you can't pay a debt, and then you're screwed. So, look at the debts you have and think about ways to retire as many as you can. If you've been someone who lived on credit card debt like a lot of people with middle class problem have, now's the time to think about ways to get off of it. Just like when we talked about the middle class problem. The more you learn about debt, the easier it'll be for you to manage. But these things do take time. So don't get discouraged. It's very discouraging. And don't let yourself stress too much. You will get through. Okay. That's all I got. Thank you. Sorry about the shorter video, but I'm trying not to just pad the videos out. My goal is to make sure I give you the information you need, be as succinct as possible and clear, and then move on to the next video. If you have questions, leave them in the comments, please. I will answer any questions I can, and if I don't know the answer, I'll try to find you a resource. So please leave anything like that in the comments. In the meantime, thank you for watching. Thank you for listening. Please like, share, and subscribe down below. We are on the road to 13 million subscribers, one subscription at a time, so make sure you subscribe. And as always, a huge shout out to my patrons, and I want to thank all of you for your support, and we'll see you in the next one.